Well, this is Current Yield, Grant's Interest Rate Observer of the Air. And I'm Jim Grant. And with me, as always, is the great deputy editor of Grant's, Evan Lorenz, the man behind or in front of the control panel. That would be Mr. French. And today we have an author, and he is Edward Chancellor, who is the creator of a fine new book called The Price of Time: Interest, Capitalism, and the Curse of Easy Money. And we'll get around to examining this thing about the curse of easy money. Evan, I was given to understand on Wall Street that easy money is rather a blessing. When did this curse thing come in?
I don't know. Everybody I talk to keeps wanting more of it.
Yeah, well, we'll get around to this in a second. In fact, a second has now elapsed, and I'm going to introduce Eddie Chancellor. I call him a little presumptively, but we've known each other for a long time. And Eddie is the author of, The Devil Take the Hindmost. That's Evan Lorenz's favorite financial history. And it's his favorite financial history, including some of the books written by the fellow who employs him, which I think is a pretty fine testament to Eddie's book, The Devil Take the Hindmost. And Eddie is a financial historian, journalist, investment strategist. He went to, there are two schools in the UK, the names of which we know, correct? Evan, one is Cambridge and one is Oxford. And Eddie went to both of them.
I think I've heard of them once or twice before.
Yes. He has some experience on Wall Street, including with Lazard and more recently with GMO. He writes commentary. Well circulated, and I dare say well photocopied from Breaking Views, which is now a division of Reuters. Anyway, Eddie is very well regarded and widely and closely read voice, an authoritative one on Wall Street and the City of London. So, Eddie, welcome and congratulations on what you have wrought. This book is merely terrific.
Well, Jim, thank you for having me.
Yes, I want to begin by asking about the title. Not so much the contention that easy money is a curse, but rather this intriguing and almost poetic phrase, the price of time. Is that not a good description of the rate of interest?
Well, I hope so, because that's why that's why I named my book after it. And so sometimes you'll hear people say interest is the price of money. I think that we occasionally talk about the price of a currency on the foreign exchange being the sort of price of money. But the point about the price of time is that money has value over time. And if you go back quite early on, as I do in the first couple of chapters of the book, and look at the criticisms that were raised against charging interest, against usury, by the likes of Aristotle made this comment, you shouldn't charge for lending money because the borrower is taking some money from the lender and the lender is demanding back more than he gave. And you say, well, actually, this is not quite right. I mean, one hastens to criticize Aristotle, but actually what has happened is a period of time has elapsed between the act of lending and the moment of the repayment of the loan. And the interest is the price charged for that period of time. Now, say, for instance, Jim, you were to lend me $100 and say, I'm going to lend you $100. I'll give back to you in a millisecond. Well, it was slightly unreasonable for you to demand a huge supplement for me returning the same sum of money almost simultaneously. But if I asked you for $100 and say I'll pay you back, say, in 10 years' time, well, that's a slightly different matter. Aristotle didn't seem to get this, but what's quite interesting is that in the Middle Ages, the church scholars largely took up Aristotle's criticism of interest, of usury, sort of verbatim. And you find that in the writings of St. Thomas Aquinas. But an English 13th century scholar called Thomas of Cobham actually had this brilliant insight. He said that the usurer were sellers of time. And then he went on to say, well, actually, time didn't belong to them. It belonged to God, and they had no business selling something that didn't belong to them. Well, we can disagree about whether time belongs to God or not, but Thomas of Cobham actually was the first person to see the usurer or the creditor as a person who sold time and was charging interest for the selling of time. And I think that's the key insight. If you then go later, and we fast forward to the 18th century, and by then I cite the French economist Turgot, the physiocrat, who was also France's finance minister at the time. And Turgot has this insight where he expressed in English terms that a bird in the hand is worth two in the bush, and that's what we call the time preference of money. And from that time preference, the fact that money is worth more today than it is in some stage in the future, the whole discounting of future cash flows and so on and so forth takes place.
So let us fast forward till the 1930s. A book produced by E.B. White and James Thurber was called "Is Sex Necessary?" Which happened to be published on the eve of White's wedding. And White said it rather alarmed his prospective father-in-law. But they asked the question, lightheartedly, is sex necessary? You asked the question, is interest necessary? This being the key question of the book, and indeed of the era in which we do business. And you answered resoundingly, yes. And the absence of interest, reflecting not so much the natural supply and demand, supply of time and demand for time, as it were, but reflecting rather the intentions of our policymakers. The absence of interest would then not be a blessing after all, but as the book suggests in its very title or subtitle, a curse. So let us forward to the present day, to the absence of interest until recently. That's an exaggeration, but it survives, the point survives. What has QE, what has the multitude of radical monetary interventions brought unto us?
Well, that's a big question. So, Jim, I mean, the contention of the book is that interest today is very poorly understood by the monetary policymakers, central bankers, economists, and so on.
Let's stop right there.
Oh.
The nature and essence of interest is misunderstood by 800 doctors of economics in the Federal Reserve System. You're bearing the lead.
So I'll tell you. So I mean, you and I know what we know, that the modern economists are trained. They're not taught anything about history of economics and finance. They don't even have to. There's no study that they don't know anything about the history of economic thought. So they don't know the sort of the rich history of interest and thoughts about the nature of interest. They tend to view interest as at least the way in which they control it, as a lever to either prevent the economy from overheating, in which case they, in theory at least, might raise interest rate, or lowering it when the economy is cooling too much. So sort of joystick in an aircraft. Now they assume in their models that the interest is always being held at an equilibrium, and that there's always a sort of fair interest, except when the inflation rate rises too high or falls too low. And that's when they come in to sort of play with the joystick. Now, the thesis of my book, which actually draws on your comment, which I think is also a very good description of interest as being the universal price. Or as Jeremy Stein, who was professor at Harvard and was briefly a a governor of the Federal Reserve, but obviously decided it wasn't the right place for him. But he writes about monetary policy getting into all the crap. And the way I see it is that the question of interest as a lever to control inflation is really only one of, and perhaps almost the least important of the functions of interest. In the book, I have different chapters looking at the different functions of interest. So, for instance, I write about interest and the allocation of capital, and I think that works two ways really. Is that the interest, and again, Jim, you've written all about it, so you know as much more about it than I do. But interest as the hurdle rate for investment, and the rate at which capital is how it's how capital is transferred from one business to another. So I argue in the book that the low hurdle rate actually contributes to two forms of capital misallocation. One is it keeps capital trapped in businesses where it shouldn't be any longer. And I think this is behind the rise of the so-called zombie companies whose interest charges, even at low interest, actually exceed their earnings. And we saw the sort of zombie phenomenon in Europe and the US over the last decade, but we saw zombies first arrive. The term was actually, as I mentioned in the book, first applied by an American economist to the insolvent savings and loan companies in the late 1980s, but then it commonly referred to in Japan in the 1990s when the Japanese brought interest rates down close to zero after the collapse of their bubble economy. So there's one problem, is you have the zombie phenomenon. And the zombie phenomenon is associated with lower returns on capital and with falling productivity. Now, there's another area where a very low hurdle rate is problematic. You can also actually have very speculative misallocation. So I would say that the unicorn phenomenon, the amount of money that's gone into Silicon Valley since 2008, and the extravagant companies, and often slightly absurd companies that have been funded with very cheap money or very speculative money is another feature. And as someone once said, unicorns feed on low interest rates. That was your comment, Jim. So or I think unicorns graze on low interest rates. The lower the better. So in fact, you see there's a sort of bifurcation of the misallocation of capital and the slowing of the process of Schumpeter's process of creative destruction. That's one function of interest that's not contained in the central banker's model.
In terms of speculative interest or low interest rates leading to speculation, as of November of last year, cryptocurrencies were worth $3 trillion in aggregate. Today, they're worth $1 trillion. And one thing that I find remarkable is news sites like CoinDesk now do some of the best coverage of interest rate changes at the Federal Reserve. They are watching rates closer than I think the Wall Street Journal is.
Yeah, well, I can answer that because there's another function of interest that I write about in the book, which is the interest as the capitalization rate, the rate at which we value businesses. Now, if you take the interest rate down to zero, then everything in theory would have an infinite capital value. And again, this was something observed by the first English economist in the 17th century, the founder of what was then called political arithmetic, Sir William Petty, says that it would be absurd to value the rent, I think, an acre of land in 60 years hence as the same price as the rent today. So the sense of a discount was for valuing capital assets was held in the 17th century. You fast forward to the 21st century, and what I noticed in the last decade is that those, and I'm going to say in inverted commas, assets like cryptocurrency that yielded nothing whatsoever were the ones that attracted the most speculation. And why I say assets in inverted commas, because the word assets derives from the French word assez, which means to have something left over. The thing about the cryptocurrencies is they were sort of nothing. There is nothing there. They're not currencies in any, or money in any true sense of the word. So they were really just a barometer of speculative froth that was being measuring the sort of excess of liquidity in the financial markets. And now that liquidity is being removed, those assets are coming back.
I have a short one-question examination for the author. You will see this as you make your worldwide tour and as you take your well-deserved bows for this most extraordinary book. And the people will ask you about things in the book, and you will have written it 2 or 3 years ago. You'll have no idea what they're talking about. And it's be quite embarrassing, but you will get over it. But let me read you one quotation, and then you have to tell me who said it and approximately when. You ready? All right. Evan, you listening? All right. Henry, you with us? All right. Here we go. Quote, will they not consider the possibility that ultra-low nominal yields might actually reduce aggregate demand while breeding financial instability, bank failure, zombification, and reduced economic dynamism? Close quote. Who said it?
Shall I tell you?
Yeah.
Larry Summers?
Yes. Well done. Well done. Larry Summers said it in 2019. This is 8 years before after saying something rather different. I have observed that Larry Summers, as smart as he used to be, is getting even smarter, which makes him not only the smartest person in the room, but the smartest person perhaps, I don't know, anybody outside the offices of grants. I don't know.
So Jim, so Larry Summers, he is he's a man with two brains. He's deeply political figure. There's a famous comment he makes to Elizabeth Warren when she becomes senator, right, saying that, what you've got to understand, there are people on the inside and people on the outside, and the chief rule of insiders is they don't criticize other insiders. Now, Summers was looking to take over from Ben Bernanke as head of the Federal Reserve. And he was the reviver of the secular stagnation notion that was first, and which I discuss in the book, which was first mooted by another Harvard historian called Alvin Hansen in the 1930s. And Hansen said, the population was ceasing to grow in the United States. There were no technological advances, and the economy was doomed to secular stagnation. And as I point out, this was really the worst economic forecast in history. And as Warren Buffett says, the US economy was born at the time when Hansen came up with the secular stagnation comment. Buffett says that the US economy, GDP per capita, had grown sixfold since Buffett was born. So secular stagnation was a poor idea, but it was a sort of politically opportune one in the post-financial crisis period. I think what happened is that Summers, didn't get the Federal Reserve job, and then thought, well, what the heck, obviously these low interests are a very bad idea. And what I'm saying is, it's fine for Summers to say that. People like you and I in our journalism had been sort of going on along that line.
Well, we are outsiders, Edward.
Yeah, we're outsiders, so we can say what the hell we want. However, there are more interesting sort of semi-outsiders, and the two who I draw upon in the book are William White, who was the former chief economist of the Bank for International Settlement, and Claudio Borio, who took over as head of research, economic research at the Bank for International Settlements after White left in 2008. So Borio and White, among the sort of establishment economists, are really, as far as I can tell, the only people who gave off a proper forewarning of the financial crisis. We can throw in Rajan, who later joined from the University of Chicago, who also gave a warning.
Yeah.
But Borio and White warned about it and wrote papers about it before the crisis. And then Borio got his team to do a lot of very interesting work, Bank for International Settlements, over the past decade. And everything that Summers has said really was already elaborated by
Well, Edward, the thing that people will understand upon reading your book is that there ain't nothing new under the sun of economic thought. And so many of the revelations that economists of the Federal Reserve Board and those of the Bank of England had not yet shared with us were enunciated hundreds of years ago. And one of the many treasures in your book is the collection of these aperçus, these insights, these maxims that come to us from very smart people who did not study economics. It's quite revelatory and not a little humbling. Let's get into the here and now and the what to do, because we are confronted with the aftermath of this most extraordinary thing. You know, we both have agreed, I think, that and Evan, I know, is of this view that low rates seem to beget lower rates, and radical policy seems to beget more radical policy. So here we are, 2022. The unforecast inflation is upon us. And interest rates, in Eddie's quite fabulous book, I read that the average interest rate in America, the basic interest rate in America from founding to the present, like 6%, right, Eddie? 6% is a kind of a median average like interest rate. So we are one half of that still. And the first question concerning the here and now and the what to do, Edward Chancellor, is the 10-year note is barely 3%. And the bond bulls are saying that the move higher is over and that inflation is diminishing, if not vanishing, and that we are back into a time of preternaturally but persistently low interest rates. Now, what say you?
Well, first of all, I say that I think it was only last year the central bankers still had their mantra, lower for longer. And if you remember the year before, Jay Powell at the Fed was saying he wasn't thinking of raising interest rates. So
he wasn't thinking. He wasn't thinking.
He wasn't thinking that much. So where are we now? Jim, do you read the piece I wrote for Breaking Views this week on the inflation cycle?
Faithfully.
Okay. So my point in the piece I've just written, not in the book, is that, and Jim, we always see that investors and everyone else, they tend to go through sort of linear extrapolations, and they think that they spot a trend, they think it goes on to the moon. And inflation is a very cyclical phenomenon. And this is based, I think I read too much Grant's Interest Rate Observer in my day. And after the financial crisis, I became convinced that there was going to be an inflation. So actually, together with a colleague,
you must read more carefully, Edward.
I said I should have buried it in the garden and dug it up 10 years later. Anyhow, I did a certain amount of work from the inflation experience in the 1970s, and we sort of crunched the numbers on currencies and bonds and equity. So what we found is that inflation was highly cyclical, and in each phase of the inflation cycle, there are winners and losers. So, and I'd say that the winners we've had in the inflation cycle this year, namely the commodity stocks, and commodities have done very well. The safe haven currencies like the Swiss franc has done well. Value stocks done well. These are all things that sort of worked on these sort of rising inflation cycles during the 1970s. But you have to be aware that the cycle's liable to be interrupted and come down. in fact, I talk about this with my friend Henry Maxey, who was one of your guest speakers at the Grants Conference last October. And if you remember, what Henry's argument is that that there are still deflationary forces out there. The world has been, the financial architecture is built around these assumptions of extraordinarily low rates, and therefore is highly sensitive to unexpected moves in interest rates. So even the move in the interest in the 10-year Treasury from sort of rough around 1.5% to 3%, and it's nothing in the great history of interest rates. But for a financial structure that's entirely built on these very low rates, that's a bit of a seismic shock. So, I think that in the near term, we're going to have a much more volatile, we're going to have more volatile inflation experience than many people think. And the thrust of my argument in the column was that people need to learn how to sort of ride the inflation cycle.
Right. Evan was big on, shares with Henry, the idea that the story about inflation, one of volatility rather than persistence.
Yeah, I think so. I mean, but Jim, if we were going out, sort of longer term, let's say, we don't know the path, but we know, if we're trying to think where we have to be or where we're likely to be in 10 years' time. Now, the break-even inflation rates are what? Sort of just under 3%, looked at them earlier this week. And I think the average inflation during the so-called Great Inflation was 7.5% in the US. So the market is pricing in less than half the inflation over this current cycle than the 7.5% inflation the US had over the so-called Great Inflation.
I would just put one asterisk there. Sorry to interrupt you, but the Fed, as part of its QE following the March 2020 lows, bought something like 40 or 50% of all tips outstanding. So maybe half the market is predicting that. So it might be a half prediction.
Yeah, yes, it's all we've got to work on. Anyhow, given that there are still tips trading, you can bet off it. You can implement your break-even inflation bet if you want, or you can buy tips yielding 6.6%, 60 basis points today, real. And I'm thinking, and this is a view that I held, and presumably you did too, Jim, before the sort of great excess of money printing and borrowing during the coronavirus lockdowns, was that the only way to get out of this situation where low rates were begetting low rates was for an inflation to burn off the excess of debt that had accumulated during this period. So I always thought, and the book was mostly written before COVID struck, I always thought this has to end in an inflation at some stage, because it's only via an inflation, a bonfire of the paper liabilities that we've accumulated, that we can get back to a stage of equilibrium, but also get back to a stage in which a fair interest rate can be can exist without actually bringing the structure down.
And you agree, don't you, that it's not merely the burning off of the excess liabilities, but rather the burning, to take the other side of the balance sheet, burning the people's savings. The idea that inflation is transitory is a very cruel myth, because you never get back the purchasing power that you have lost to inflation. You never get back in a regime in which 0% inflation is the lowest possible inflation rate to be tolerated. So the loss of 7% or 8% in purchasing power, that's it, gone.
I'm not an inflationist, you know that.
I know that. Fact, I blame you only for one thing, and we're not writing your book sooner, because had I seen this marvelous quotation from Cantillon, the 18th century French economist, concerning what happens when the central banks create extra monetary balances that wind up only in the banking system, trapped, as it were, within the financial system. There's only inflation of financial claims and not of things at the checkout counter. And if I had seen this quotation on page 64 of the proof of your fabulous book, I would not have erred in 2009. I don't want to point fingers, but it would have been helpful, Edward, if you'd been a little quicker on this book. That's all.
So Cantillon is the great hero, and I actually talked to him about him to your conference in 2018.
Yes.
Yes, it's and his insight that and I say that John Law in the Mississippi era was the first, who was both sort of first central banker in France, plus the stock jogging promoter of the Mississippi Company, that he was the first practitioner of QE, and as Cantillon observed, that the French central bank printing the money initially just blew up the share price of the Mississippi Company, which was very nice if you own Mississippi shares. But in the end, John Law then had a choice between uncontrolled inflation or arresting the bubble. In the end, he chose deflation, lost his job, lost the greatest fortune in history. But he sort of, he did the right thing. And in that case, the French government could sort of step in and renegotiate the claims on its debt. The trouble now, the inflation is the only, or what Russell Napier refers to as financial repression, the keeping of interest rates below the rate of inflation is the only way to sort of burn off the debt. And I think it's tremendous injustice. And there's no doubt about it. And I think, people will get burnt. And I think that the sort of negative public feelings, or what people call populism, will be aggravated by these inflationary times.
Let me ask you about an observed tendency in the bond market. This is rather a somewhat familiar theme to the readers of Branson. Perhaps it's a little bit too familiar because it has not been entirely helpful in timing one's investment. But the observed tendency of interest rates is to trend over the course, not of fiscal quarters or merely years, but rather of decades and generations. So the great bull market that began in 1981 in bonds, meaning the rise in bond prices and the reciprocal fall in bond yields, that perhaps it's ended. If it has ended, it lasted for 40 odd years. And the preceding bear market in bonds, meaning, of course, falling prices and rising yields, that was a 35-year event from 1946 to 81. And preceding that was like 25 years falling, and the turn of the century to 1920 was a 2-decade event of rising rates. So insofar as the observed history is indicative of what might follow, do you think that we are perhaps embarked on a long cycle of rising interest rates? And if so, what are the implications for the things that people own in the way of a 401k?
Well, I noticed, Jim, that you now call turns in the bond market with great temerity. I think it's going to be the case, and remind me if I remember, was it in late 2020 that the 10-year Treasury saw its low, perhaps it's all-time low, but the low of this current cycle?
Yes, so 1/2 of 1% or so.
Yeah. So I'm reckoning that was the turn in the bond market. I think it would be. So, when I say that the turn in the long cyclical trend, I think, and you tell me if I'm wrong, I think it would be remarkable if we'd find that with inflation being whatever it is, 9%, or depending, take out the hedonic measurements, and heaven knows what inflation is at the moment. But I'm thinking it would be extraordinary if the 10-year Treasury would find a new low from where we are today. And I think it's therefore likely that we are, we're beyond the turning point of a multi-decade cycle. So where does that leave us? And by the way, there are other things that point in that direction. Charles Goodhart, the British economist, are arguing that sort of the aging of aging populations, contrary to what was said in the whole secular stagnation hypothesis, where they use the argument for lower interest rate, so for aging populations for lower interest. Goodhart argues that the aging of the global population, in particular the aging of China's population, and other forces leading to the unraveling of globalization will drive interest rates up. Now, I think it does seem, and you'll know this, Jim, that periods of inverted commas globalization seem to coincide with bond bull markets. So take the late 19th century, and there's sort of reason to think that why that might be the case, because if developed countries are trading more with developing countries where labor is cheaper, that's a sort of downward drag on wages and interest, and downward drag on wages and inflation. And those are two components that sort of go into the interest rate. So I think that interest rates will be trending up,
Okay, well, let me ask this. You are an alumnus of GMO, which is famous for long range forecasts of relative value in different asset classes. People at GMO will tell you that they really, is it a 6-year forecast that's the specialty of the house?
Yeah, the 7-year forecast.
7-year. Would you care to rechannel your GMO experiences and project them? This is an unfair question to put to any historian, just because you.
No, but I mean, I'm prepared to, as the English say, punt on investment.
Evan, does punting mean guess? Do you suppose?
That'd be my best guess. Yes.
Yeah. Okay, go ahead. Yeah, go ahead.
So I was actually talking to several of the, I actually talking to Ben Inker at GMO last week, but also to Rob Arnott at Research Affiliates, Cliff Asmus at AQI, who's $2,000 to answer me directly. His communications director got back to me. Anyhow, I was just looking into value, something that Grant writes about from time to time, and it does seem that value is in the 1970s, U.S. value, particularly after the bursting of the sort of Nifty 50 bubble in what was it, so early 73, the U.S. value went off on a tear, and investors got, although the U.S. stock market was massively derated, it went from a sort of Schiller PE of 24 times in 66 to 7 times by 82, that value stocks actually delivered a positive inflation protecting return. And value is not so attractive today. It's not stunningly attractive today, but it is relatively attractive. When I say relatively, AQR have a sort of value, global value adjusted for industry neutral value spreads, saying that they're 95th percentile, the spreads are wide. So they're sort of cheaper than at any time except in 1 year in 20. So value, I think, is good. And actually, before we got on this call, I was speaking to a former colleague of mine who's investing in Japan. And he says that his value opportunity in Japan does look stunningly cheap. The emerging markets value is also good. I mean, I think you have to be aware that some of that's coming from Chinese state-owned enterprises. So I think I'm personally in favor of sort of emerging market ex-China. And then the European value looks cheap. And UK. So I think I'm not saying that you're not going to get better investment opportunities over the next decade, but I think value offers a reasonably good opportunity. I think going back our friends the tips, I actually think a 0.6% real yield over the next decade is actually not a bad return. I mean, I personally didn't mind holding tips when they were trading at negative yields because they are inflation protected or inflation insurance. And I think probably that, and this is an argument my friends at Ruffer say, is that at some stage over the next decade, people will be bidding the TIPS yields down into negative territory because they're desperate for inflation protection. I don't know about gold. I mean, I like you, Jay. I think gold is something to hold in the portfolio. It's not as cheap as it was, obviously, in 1970, because in 1970 the price of gold relative to the dollar had been, depressed, suppressed by the whole Bretton Woods period. But I think that if inflation gets out of hand, then people will want gold. I mean, they've obviously been, massively disappointed by cryptocurrencies, and gold, as you and I know, is the real McCoy, or as my friend Felix Martin calls it, the world's oldest bubble. So I think the world's oldest bubble will come back. So what else? I think there's going to be difficult times ahead. I think the ructions we've seen in the markets this year, Henry Maxey's inflation volatility, is only sort of starting, and that there is a lot more of it to come. I think you can build a portfolio with positive expected returns. I think the 60-40 portfolio, 60% US equities and 40% treasuries, is going to lose. I think it's going to do what it did in the 1970s. It lost half its value in the first half of the 70s, and it was much better starting out valuation than it is today. So I think that investors in conventional 60-40 portfolios are going to be, I hate to say it, but I think they're going to be completely hammered. I mean, they had a bad year to date, but that's just the start of it, as far as I see.
Yeah. Well, Edward Chancellor has not only written The Price of Time, which you must read, but he also is going to speak at the Grant's Interest Rate Observer Conference on October, 18th, Evan? Yeah, 18th in New York City. So you must hear. You do multimedia, do you not? Here you are doing podcasts, you have written, you write, and I think also you speak. So that's what we call in baseball a triple threat. So
well,
it's been wonderful talking with you, and we must do it more often. It's very terrific indeed. So thank you, Henry. Thank you, Henry French, and Evan. As always, good to see you. And ladies and gentlemen, good to imagine seeing you. Thank you for listening. Until next time, this is Jim Grant on behalf of Current Yield, Grant's Interest Rate Observer of the Air.